Hi everyone, and welcome to the Everyman Investor. So, firstly, a happy new year to all of you, and I wish you great investing success for the year. As you can see from this empty chair here, it appears that we have missed our center rally. So the question is, where's center been? And it appears that he has left the party a bit too early. So, traditionally, during this period of time, the stock market actually goes up, which is basically the last 5 trading days of the year and the first 2 trading days of the new year, which is 2024, which we are in now. And that is typically called the center rally. Now, this has occurred 19 out of 24 years since 1999. And the average returns during that period is about 1.3%, which actually, if you're trading in options, you can get quite a good return if you are sort of basically looking for returns over a short period of time. Even if you're not looking for returns over a short period of time, the rally is nice. Now, the absence of the center rally is seen by some analysts as being a bearish indicator of the year ahead. But it really depends on whose work you read and whose research you follow. Um, there are some who say that there's actually no correlation whatsoever between a center rally and how the market is going to go over the next year. So I would say take it with a pinch of salt. The question though is, has the good news been fully priced into the stock market, given how much the market has moved in the past month or so? Whether or not the market has realized that the Fed might not be cutting as much as the market thinks that Fed may be cutting, new conflicts brewing in the Red Sea, etc. Now, the last week actually saw some release of data, economic data, and the December 2023 US manufacturing PMI is at 47.9, which is a continued trend below 50, which shows that the US manufacturing sector is actually contracting, which is not a good sign for the economy. And there's jobs data this week as well, which could trigger a market move either up or down. If the job market comes in too strong, then the Fed might not cut rates. If the job market comes in too weak, then the question of recession comes into the picture again. So getting the Goldilocks picture, as a lot of people on TV, a lot of analysts are saying nowadays, is getting harder and harder by the day. Now let's look at the S&P 500 ETF over the past week or so. As you can see, there was no rally. It actually dropped slightly after trying to struggle to rally initially. On the other hand, if you look at the US 10-year Treasury yield, it has been going up in the past week or so. And it just came down a bit to about 3.9% or so. It reached 4% again just yesterday. So basically, as I mentioned previously, there is an inverse correlation between Treasury yields as well as stock prices. Now, if we pull back things a bit further into the month of December itself, now this is the S&P 500 chart from Yahoo Finance. As you can see, it has actually gone up more days than down. So the green bars are days when the market has gone up, and the red bars are days when the market has gone down. The thing is, if you look at it carefully, the RSI, which is the indicator I use for whether a market is overbought or oversold, has been overbought from about 12th to 19th, which means to say that the market entered the late part of December in overbought conditions. And according to other analysts who use different metrics and different analytical tools, the market was overbought, and some of the analysts have actually advised to sell because the market will be dropping. In fact, a certain analyst on one of the news networks has told subscribers openly that it is time to sell and take some profits. So why did the center rally fail this year? And more importantly, what should we do about it, and what should we read into it going ahead? So as I mentioned, the market entered the period of the rally in really overbought conditions, and stocks cannot just go up forever. Stocks go up and down. Uh, we hope it trends upwards, but the thing is, it never goes up in a straight line. Treasury yields again started increasing, and basically this decreased the equity risk premium, which basically people will buy into treasuries again instead of the stock market. And then there was profit taking, especially from traders. As I mentioned, if you watch the news, especially certain news channels that are dedicated to market analysis, um, traders using technical analysis have been advising to sell and take profits because they see the market having gone too far up in too short a time. Now, the other issue is that investors have been rotating sectors and asset allocations. Now, these investors are not the retail investors like you and me, but these are the institutional investors. So the thinking is that sectors that have performed well in 2023 will not perform as well in 2024. Sectors that have performed badly in 2023 will be the ones that lead in 2024. The rationale is simple. A company that has soared, say, 70% in the previous year is unlikely to soar 70% again. Now, on the other hand, a company that has dropped 70% in the preceding year, the chance of more bad news coming if the company is well run is probably not going to be very high, and there's a lot more room and chance of the stock going higher in price if there's good news coming from that company. So for me personally, I did sort of allocate extra assets. I bought into funds that are invested in debt, in terms of corporate debt, corporate bonds, um, in December itself. Because as I mentioned previously in a couple of my videos, I wanted to lock in the higher yields while the yields were still high, assuming the Fed does cut rates in the next year, or rather in this year, 2024. Now, there's also the issue of economic uncertainty. So, number one, the Red Sea situation is getting a little bit worrying. Iran just sent a warship into the Red Sea because the US just sank ships of the Houthi rebels that Iran is sort of sponsoring. Basically, this is affecting trade routes for ships, and the alternative route around Africa, around the Cape of Good Hope, basically increases the cost of shipping your goods, which basically can lead to a reinflation occurring. And if inflation goes up again, then the chance of rate cut is going to be much lower. Then there is the continued contraction of the manufacturing sector, which I mentioned previously from the PMI. That is another issue. You cannot just keep having contractions. In order for the economy to go higher in terms of GDP, your manufacturing sector has to increase and be expanding rather than contracting. The last issue is that so there are basically markets that predict how much the Fed funds rate is going to be over the next year, and the market actually sees a 1.5% cut in rates in 2024, which will equate to 0.25% rate cuts. The Fed, on the other hand, as I showed you in a previous presentation where I showed you about the dot plot, is only pricing in 3/4 point rate cuts, which means to say that the market might be a bit too optimistic, which leads to people getting a bit worried now, and hence taking out a bit of money as they have profited over the past month or so when things have gone up quite a lot. So now for us, if you are in a short-term investor, you need the cash in the next, say, 1 to 2 years, it's not a bad idea to take some profits now. For those of us who are in the medium-term 3 to 5 years range of investing, I would say that if things do not go wrong, it is probably a good idea to buy on the dip, although at the moment I do not think the dip is deep enough. There was an analyst on TV yesterday who mentioned that the first 3 months will probably be very volatile, and there will probably be a correction at some point in time, and that will be when it might be a good idea to buy into the market, assuming that the next 3 months of economic data is good, and also more importantly, the next quarter's earnings, how that comes along, because that will be Q4 of 2023 earnings, and it will give us an idea or not whether or not Q3 of 2023 was really the bottom in terms of earnings. If Q3 2023's earnings were really the bottom, then we can probably see a bull market coming and sustaining a bull market for the next few years, assuming no catastrophic events happen. So what I'm doing now is I'm sitting still, sitting on the fence and seeing how things go in terms of the Fed, the economic data, and I'm also waiting eagerly for the next earnings season to start, to see and compare how earnings have fared in Q4 2023 versus Q3 2023, and also versus Q4 2022. Now, if earnings have increased, then that will be a good sign that we can enter the market with more confidence. On the other hand, if earnings decline, especially for those in service sector as well as consumer goods, then it shows that the consumer is weakening, which means to say that it might be a good idea to hold on to cash, and like I said, lock in some of the higher yields that are still available in terms of corporate debt and government debt, and basically reallocating those assets when the economy is on a firmer footing. So thank you for watching, and I hope to see you soon in my next video. Hopefully this was useful. Just sharing my thoughts as usual. And let's look forward to how the next earnings season comes along. I'm hopeful for a good earnings season, which will basically be sort of a semi all clear, especially if you have got companies that you are watching closely and they post really good earnings and give really good guidance. So thank you for watching, and I wish you a prosperous 2024.